Coming up on Market to Market, the targets for national security and tariffs move elsewhere. New research on who is paying for those tariffs. Looking for new ways to squeeze profit from the pick of the peck. And commodity market analysis with Dan Hueber next.
I wouldn't be here without my customers.
Yeah, I'd like to thank the customers. They're very dear to our hearts.
It's about the people that you're working with and the relationships that you have.
Thank you.
Thank you. Thank you. Thank you from the bottom of my heart.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, January 23 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. Winter arrived in the eastern two-thirds of the country this weekend. While that portion of the U.S. will be digging out, the government is still buried in old economic data from the shutdown. This week, the news came from the volatile food and energy sector measured through the PCE, that's the Fed's preferred inflation gauge. The monthly figure was up 0.2% and added 2.8% in the year-over-year reporting. Now, while those lookbacks are still happening, it was the path ahead on the global stage that made even more headlines. World leaders gathered where winter is often a part of the backdrop in Switzerland. This time it was another land and a new set of tariffs that was clearly in focus, as David Miller reports.
I made because people thought I would use force. I don't have to use force. I don't want to use force. I won't use force. All the United States is asking for is a place called Greenland.
During events around this week's World Economic Forum in Davos, Switzerland, President Donald Trump retracted his latest threat to impose tariffs on 8 European nations, including Denmark and the United Kingdom. The move was seen as an attempt to bring European allies to the negotiating table to agree with a U.S. takeover of Greenland.
And all we're asking for is to get Greenland, including right title and ownership, because you need the ownership to defend it. You can't defend it on a lease.
After the president threatened a 10% duty on all goods from countries opposing his takeover of Greenland, the U.S. stock market and the U.S. dollar index moved lower, while the price of gold moved higher. When Trump announced he had negotiated a framework of a deal with the head of NATO, U.S. stocks recovered some of those losses, but gold remained slightly higher.
It's the ultimate long-term deal, and I think it puts everybody in a really good position, especially as it pertains to security and minerals and everything else.
However, the leaders of Denmark and Greenland still say the sovereignty of Greenland is not negotiable.
As I hear it, the will to have Greenland, to own Greenland, was still a part of the rhetoric yesterday. But as I said, respectful dialogue through the right channels is what we have been seeking from the get-go. And I also feel that's the intention now from the other parties, and I'm happy for that.
All of this comes on the heels of a Kiel Institute study analyzing who pays for all the tariffs. According to the white paper released this week by the 100-year-old Kiel, Germany independent think tank, American importers and consumers paid nearly all of the entire cost of U.S. import tariffs, despite Trump administration statements to the contrary. Research revealed that foreign exporters absorbed only 4% of the tariff burden, while the remaining 96% was passed on to U.S. buyers. The study used shipment-level data covering over 25 million transactions, valued at nearly $4 trillion. There was also a closer look at what it called discrete tariff shocks that included a 50% tax placed on goods from Brazil. The conclusion was that export prices did not decline, but trade volumes collapsed instead. Chinese exporters, despite facing significant new trade barriers, did not cut their prices to maintain market share. Instead, the amount of trade was reduced as fewer Chinese goods entered the United States. The paper concluded that tariffs function not as a tax on foreign producers, but as a consumption tax on Americans. Kiel Institute researchers found the amount of money in U.S. customs coffers increased by $200 billion, and every dollar of tariff revenue was a dollar taken from American businesses and households. For Market to Market, I'm David Miller.
An apple a day is supposed to keep the doctor away. That constant supply is only part of the economic equation for the industry. Most orchards put out the best-looking fruit to grab the shopper's attention, and the rest is used to supply pies, crisps, and juices. The global cider industry is having a renaissance with more than $5 billion of global business in 2024. One orchard in Minnesota is taking the best fruit to help cash in on the trend and add another leg to stand on for their business. Peter Tubbs has this week's cover story.
A harvest crew picks apples on a foggy September morning at Keepsake Cidery in Dundas, Minnesota. The orchard is unique for the region for both the heirloom varieties of apples and that they will be crushed and used for cider rather than be eaten.
But then why I picked apples, I just love the fruit. I've always loved the fruit. I grew up in a place that loved the fruit.
The 7 acres of orchard at Keepsake are relatively young, but host some heirloom apples that trace their lineage to colonial America and Europe. Varieties like Ashmead's Kernel, Chisel Jersey, and Golden Russet grow next to output of America's land-grant universities like Liberty, Sweet 16, Haralson, and Keepsake. These apples are prized for their high tannins and sharp flavors, which add complexity to the ciders Waters bottles with his wife, Tracy Yunkman. Compared to annual crops, the organic orchard was an easier entry into agriculture for Waters. Summers spent working on vegetable farms confirmed his preference for orchards.
For me, in a word, relationship. I enjoy this long relationship that I have with that perennial crop. It almost feels like when I've farmed annuals for a long time, it almost feels like with the annuals are always like a new relationship. You know, a new year, a new season.
The first of the 5,000 trees were planted in 2015, but growing apples outside of the arid Pacific Northwest is a challenge.
I believe our apples taste better. I believe our apples are better, and I think that's the reason why you want to grow apples in the Midwest, in the upper Midwest, is that we grow really, really good fruit. The challenge is largely fungal issues, some pest issues, but mostly fungal issues that require more attention. We're okay with our fruit not being perfect looking, and we have other ideas on what to do with those.
Keepsake is operated as 3 separate businesses: the orchard, the cidery, and the tasting room and event space.
The cider industry, since we began, has gone through some pretty radical changes. You have to remember, 20 years ago, there was very few cideries in the United States. Cider had almost died. And there's cider like what we're trying to do, which is more traditional. You're going to be long aged. You're using particular type of apples. We're spontaneously fermented, no sulfites added. We're doing pet nats and Charmat methods. We're doing champagne styles. So it was great that we at that point we could just start talking about what we're doing, and not just try to get people into what cider is. And then you've had all these trends, ups and downs and ups and downs.
Tracy Yunkman runs the retail side of the cidery in addition to her off-farm job. Introducing customers to their cider varieties is a key part of her work.
It really takes a little bit of education and then, frankly, just tasting the cider. Like people, when they have an idea of what they're coming in with when it comes to cider, are typically like thrown for a loop when they drink our beverage. You know, there's no added sweeteners, no added flavors, no added colors.
On a cool day in November, a harvest crew is rushing to bring in the last of the apple crop before the Minnesota winter sets in. The 60 varieties grown at Keepsake ripen at different rates, so harvest can stretch from mid-August through the first hard freeze. Processing takes place through the fall and into the winter months. Apples are washed, then ground into a mash. The mash is wrapped in fabric and then crushed using a custom-built press that generates 3,000 pounds per square inch. The juice from each variety is stored separately, then blended with other varieties depending on the goals of each cider.
I have all these characters that I can pick from as I try to tell you a story for that eventually that I pour to your glass that hopefully you find fun and relevant and interesting. But if I only had 2 apples, it's going to be the same story every time, right? So it's fun to have all these characters behind me.
The ciders at Keepsake spend 12 to 18 months fermenting using the natural yeasts that were present during the crush. This traditional process produces ciders with complex and authentic flavors. The scale of the orchard and cidery is large enough to be profitable, but small enough to maintain a relationship with both the apple trees and the cider customers. Direct sales to consumers are the most profitable and often require spaces for sampling of the different types. The event spaces form the third arm of the orchard's business. The event spaces are open around 100 days of the year.
We are a farm-based operation. We really believe in focus on the apple and in processes that really respect the land, the water below us, the product itself. So we use a variety of apples, but really the apple makes the difference in our cider. You know, a lot of what we talk about is our natural processes. We're really unique in the cider making world. Natural cider that's spontaneously fermented with no additions is a rare thing, even nationally.
I believe that being a small farm and trying to farm and be economically, emotionally, and ecologically sustainable, we need to find ways to connect directly to our market.
For Market to Market, I'm Peter Tubbs.
Next, the Market to Market Report.
Depending on when you're watching this, you are either in the middle or past the first great winter storm of 2026. Snow, freezing rain, and cold are the trifecta this cycle. Trade ahead of the storm prompted wheat watchers to see what the system would do to the crop, which was already getting a boost late week in the form of export sales. For the week ending January 23, the nearby wheat contract gained 12 cents, and the March corn contract added 6 cents. Bean oil helped buoy the soy complex. The March soybean contract improved a dime, while March meal put on $9.90 per ton. March cotton contracted by 82 cents per hundredweight. Over in the dairy parlor, February Class 3 milk futures added 24 cents. The livestock market was higher. April cattle gained 183. March feeders put on 373. And April hogs put on 98 cents. In the currency markets, the U.S. dollar index fell by 163 ticks. March crude oil expanded by $1.44 per barrel. COMEX gold strengthened by $402.20 per ounce. And the Goldman Sachs Commodity Index was up by more than 8 points to settle at 573.15. Here now to lend us his insight on these and other trends is one of our regular market analysts, Dan Hueber. Hello, sir.
Hello, how are you?
You know, this week was a different week.
Okay.
In responding to folks like you. Or it was different more for you than it was for me, maybe. Less angry calls this week?
Oh, I don't know if there was any, angry, maybe not the word. There was depressed calls maybe the week before after the WASDE report, the previous Monday. But, here we are a little over a week beyond that, a week and a half beyond that, and prices have largely stabilized. And, of course, closing up for the week means that we've kind of taken those numbers, absorbed them into the price structure, and even rallied a bit. Now, can we sustain that for very long? That's maybe a whole nother question. But at least it's saying that the world didn't quite come to an end with that report. So.
And there were improvements that were consistent with last week. I mean, we still actually put on a couple of things. It's just the middle of the week was the problem. Monday was the way we report things Monday to Monday, or Friday to Friday here, different from the rest of the world.
Correct.
So given that it's behind us.
Sure.
Is it truly behind us?
Well, it's going to hang over us for a while until we get something new to talk about. And realistically, we probably got several weeks ahead of us before there is something new to talk about. Yes, we'll discuss acreage and grain stocks and those type of things, but we really don't start getting updates on that until February when the USDA has the annual symposium. They'll do some baseline numbers at that time. And then, of course, at the end of March, the actual prospective planning numbers. So the market shift will probably move a little bit from, we're looking at these bigger supplies than we really anticipated 2 or 3 weeks ago, to, well, what are we going to look at for acreage in this coming year? And yeah, right now, for all intents and purposes, we'll probably lose some corn acreage, maybe gain some of that back in the soybeans, maybe some of that even in rice or something. But on the same token, it's, there's just really not a lot to stimulate markets at this point in time. So.
The weather's trying to help the wheat market right now.
Oh, well, realistically, how many winters do we not try to kill that wheat crop 2 or 3 times? So it's, I wouldn't say this is out of the ordinary, but, and, chances are create some damage. And, we don't have any excess acreage in wheat out there, so it's not like we can lose a lot. But here again, it's far too early to say just how much we're going to damage to.
But this is going to be a theme, and it has been a theme. We are in a trend here for the last 6 weeks, or a range. More or less.
Range, correct.
Not necessarily a trend, but a range.
Right.
Why is that?
Well, I think we're at value. When you look on what's going on with the world trade right now, and granted, great boost in the export sales here in this last week. Now, if that's anything more than a one-hit wonder, it's a little difficult to say at this point in time. But we're competitive in the world. The dollar deteriorating probably is a nice little bonus for us at this point, as far as maybe stimulating some extra business. Some of it just could be the available supplies here right now. We're going to lock it up while we can until we see what South America really comes up with supplies. So it's, I wouldn't call it a long-term thing, but, you take all the help you can get at this point.
No, you just answered my question, because I was going to say we're 30 cents off the highs. I'm guessing we're holding, and you just said we're holding. Let's go to corn, because that was the big headline of last week. But then there's been some, I don't know if you want to call them Tuesday morning or beyond, quarterbacks say, well, it wasn't that big of a surprise because of this, this, and this. What did you take away?
Well, of course, part of it came from increasing last year's supply that bumped that carryout number up there. Not shocking. Of the overall number, I thought the most stunning part was that they did bump up carryout as much as they did. I think the trade was really looking for us to kind of edge back below that 2 billion bushel mark. Instead, we got pushed up to 2.3, I believe, right in that neck of the woods. So, psychologically, that just really kind of takes any major concern out of the corn market. Now, granted, yes, we have a lot of growing season in front of us. We could be down 2 to 3 million acres. So, that puts some kind of a value, at least on the bottom side. But really, when you look at what happened post-report, we had the big crash down on that Monday. And we've just gone nowhere since. So, all right, maybe there's some value buyers in there, but there's very little reason to really stimulate it much above this current level either.
But we weren't going anywhere before the report either. We were stuck in a...
True, just a little larger range, but at 15 cents higher than we stand today. So, no, and again, when you say 6 weeks, it's really more like 5 months. This corn market has really been quite stagnant. It's just we're stagnant at slightly lower levels here at this point in time.
But what did this export news mean most to that came out before Friday?
Well, the corn was really the most surprising number of the bunch, 4 million metric tons. A lot of it to unknown destinations, so it'd be interesting ultimately to see where that happens to go to. But, they were looking for a good number, still looking for over 2 million metric tons, so you had over double that. So that was a nice, pleasant surprise. Soybean number was certainly strong, but expected. So it was the grains that really had the best play here from those figures this week.
Given what we've gone through in 2026 and in the past, our December corn specifically, are you hearing folks are just saying, I'm taking advantage of what I can now, or they're locking it up and holding? What are you hearing?
I think a lot of people are sitting tight at this point in time. For as much as anything, we're not that far off of the month of February when you set your crop insurance price. Once we have that price set, then I think people will start devising a little more solid marketing plans.
All right, well, let's discuss maybe some other help that could come, and it came in the form of a question. Scott in Iowa, who's a good friend of the show on social media, if you haven't followed him, he's a lot of fun to see, and he's been working hard, and thank you, everybody who's working in these cold conditions this weekend. He says, is our only hope a Hail Mary to get an improvement in corn and soybean prices?
Yes.
And what would that Hail Mary look like?
Hail Mary's going to have to be weather. So, I mean, it's going to have to be something that, demand, even though we're going to see spurts here and there of increases in demand, we're not going to change the picture dramatically. So it's going to have to be on some, possibly on reduced acreage, although I think the major the major impetus would be a weather issue if that happens to come about, and that's something that's difficult to count on. Now, all that said, usually you'll get your seasonal low, in this late January, February period, the traditional February low, and then we'll try to build some kind of risk premium as we move into the spring months to give a little incentive there to get the planters rolling again.
But we hibernate a little bit, is what you're kind of saying.
To a certain extent,
certainly.
Yeah.
Let's talk beans specifically now.
Sure.
Again, export numbers. Let's start with that. Continue with that number. Not as high as the corn number, but still positive and above expectations.
Still a good number. Yeah, I mean, and again, it's not that we haven't seen those kind of numbers. That was a marketing year high, so the best we've seen since September 1. So China, again, a strong buyer, but we're at that period. You've already got South American harvest started. Probably 3-4% complete at this time. So you're within a few weeks of having Brazilian beans back onto the world market. We're filling in that in between space. Of course, China is also trying to live up to the obligations of what they said they would purchase, which they now have done. And unless there's some really great financial incentive to do more, they've probably just about tapped out the demand they're going to come for at this point in time.
You mentioned a few minutes ago about soybean acres. As we look to the November contract, is there really going to be that much of a change, or is everybody's decision made? And how much of that can play into our action here moving forward?
And it's difficult to think about any kind of a major increase in acreage on either corn or soybean. Well, I mean, corn, like I say, I think we're probably pretty well assured it's going to back off. The only reason it would switch over to beans, of course, would be the fact that it's a lot cheaper to produce a crop of soybeans than it is to produce an acre of corn. So you might see some switch over that way. But I think we're going to have to look, particularly in the southern states, maybe there's going to be an alternative crop. Maybe we're looking at sorghum. Maybe we're going to look at rice in the south. That could be an alternative this year.
Or is it cotton?
Or is it, well, maybe cotton's a possibility, but cotton certainly doesn't have a bright picture at this point in time either. So it's not like those people are cheering about the profitability they're looking at.
Cotton has been in this trend that every time we look at it, it seems to be going down. There was a bright spot early in the week and
tried to rally, but here again by the end of the week it's pretty much taken all that back. So it's sitting down towards what has been the lows over the last year. So like I say, once again, it's just none of these have a great picture. And unfortunately, when you look at the overall cycle in commodities, we're probably 4 to 5 years yet before we're out of the woods. And when you look at those turnarounds, they always happen because you've developed a new demand engine that has really taken you away from the norm. Right at this point in time, it's pretty difficult to think or envision what that demand engine is going to be. So,
has the demand bug left the live cattle market?
Well, I think it's been tempered. Certainly it's, granted we've had some maneuvers by the government to try to get a little more beef into the country, which not that it's collapsed by any stretch of the imagination, but I think it takes the top end of it off. Good response back here today, but it's really just kind of teetering on the edge of falling over. And I think if we see any more slack in demand, we could probably see cattle market start to work its way back lower again.
And we mentioned the weather story. That is something that may or may not play out depending the severity of. Snow is one thing, cold is another when it hits the cattle regions.
Certainly.
Stronger there. So we'll see how that one shakes out. Let's talk about cattle on feed numbers that came out just before we started to roll here, Dan.
Yep.
The ones that came out today, I think it was 98% on feed, 95 placed, 102 fed cattle marketed. What number stood out to you?
None of them very far off of estimates. It marketed 102 was exactly what the trade was looking for. Both the on-feed and the placements were a % higher than estimates, but here again too, it's well within the ranges. So I wouldn't say that's going to have any major impact come Monday on these markets.
What is going to have a major impact on the feeder cattle market?
Well, I guess good question at this point. Weather will still be at play. I mean, we'll probably see what kind of reports we get out of the storm damages and what kind of issues they have on the pasture conditions. But boy, outside of that, it's going to be just what we get in this retail move.
It's like the feeder and the cattle market, to an extent, have both kind of stayed in that range that the grains have been doing here lately. Is there a reason for that?
Although at the other end of the spectrum,
correct,
of course.
Correct.
We're at the upper side. So, but I think it's, we've reached a point of, I don't say a point of no return, but a point where if you push any higher, how much further you're going to start choking off demand, particularly when you have other competitive meats out there, more so to the poultry side at this point. And hogs have had a pretty respectable rally here over the last 3 to 4 months. So that's equalize things out a little bit, but still, beef is, Americans love beef, but there's a certain point where, we're going to back off buying it, or they're going to back off buying it, I should say, if we can find a better competitive meat out there.
And what else is going on in the hog market this week?
Outside of that, I guess there's not much news. We did push to the upside once again, pretty much a seasonal move. I mean, this is a typical move coming out of the fall months. When you look out into the summer months, you're actually already pushing up into what is pretty good resistance level. So not that it doesn't look fairly positive at this point, but to make it extend much further than it has might be a challenge.
All right. Well, we'll challenge you with a couple of questions in Market Plus. How about that?
Oh, that sounds great.
All right, Dan Hueber, everyone. Thank you so very much for your time. That's Dan Hueber, and you've been watching the analysis portion of our program. In a moment, we will continue our discussion in an online-only segment. Search Market Plus with Dan Hueber wherever you get your podcast to hear that conversation, or you can go to our website of markettomarket.org. Facebook can connect us in many ways. We try to keep you up and in the loop on our stories, program, and podcasts, while seeking your input for our analysis and plus segments. Join the conversation on our page of Market to Market Show. Next week, building an agriculture program that's feeding a changing local community. Thank you so much for watching. Have a great week.
Market to Market is a production of Iowa PBS, which is solely responsible for its content.
I wouldn't be here without my customers.
Yeah, I'd like to thank the customers. They're very dear to our hearts.
It's about the people that you're working with and the relationships that you have.
Thank you.
Thank you. Thank you. Thank you from the bottom of my heart.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.